Good morning, everybody. How y'all doing? I'm heading on into work here in a few minutes, and I was thinking about it this morning. I don't know if y'all have heard of the debt snowball and a debt avalanche. It's not what this video is about, but the debt snowball is you throw a huge chunk of money towards your smallest bill, which is usually like a credit card or something. When you throw that chunk of money at it, the payment goes down. Don't change the payment on the credit card. You know, if it was $150 a month, you throw a big chunk of money towards it, now it's $126 or whatever, you keep paying the $150 and knock it down. Just don't use it, cut it up or whatever and get rid of it. But and then get that paid off and move that $150 to another bill, get that bill paid off, and you move the $150 and whatever the other one was to another one, etc., etc., etc. And that's basically, in a nutshell, what the debt snowball is. The debt avalanche, same principle, but instead of going with your smallest bill and working your way up through your bills, you start with the one that has the highest interest rate. So whatever the highest interest rate is, chunk your money towards that. And in my opinion, it seems like it would be the credit card, all the same. But anyway, you do it, highest interest rate to lowest interest rate, and that supposedly well, not supposedly, by the numbers, that will pay your debt off faster. But for the way I understand it is, there's more success with a snowball than it is the avalanche, because with the debt snowball, you can see it, it ain't as gradual, and you can see it happening pretty quick, because you pay off the one, hey, it's kind of like a little rush. I paid off this bill, and you pay off the next one, you get another little rush. And I actually used the debt snowball myself to pay off right much debt. We paid off credit card, car, house, etc., etc. But anyway, the reason I'm telling you about this is my plan was I was going to get into do the rental real estate, buy and hold real estate investing, and I was going to go at it as hard as I could for like 5 years and try to replace my income in 5 years. And it's a little cold and I'm a little shivery, so if I'm sorry I'm talking like this, but anyway, it's because it's not an instant gratification, I'm finding it more and more difficult to just chunk money into something that I'm not getting anything back out of. So I'm about to change my investment strategy a little bit. The next 2 houses that I buy, I'm going to take that money and buy my wife a new car, so we have a little gratification, so it doesn't look like we're not getting anything back out of it. And eventually those houses will pay off that car, and then they'll get moved into the retirement fund. I think I'm going to start thinking more like that, just so I don't get bored. I get bored easily. But I'm thinking, still pretty much the same principle of things that I want to do. It's just like that I can live my life a little bit more, and I'm not going die hard, throwing everything I have into this investment plan. But anyway, I just wanted to throw that out there for you, and hopefully, might help you out if you're like me and you get bored easily. All right, I'll talk to y'all later.